very unusual. What I plan on talking about, I'm not going to talk about, because since Monday, as I record this on Wednesday, the 14th of November, I've had 3 calls from large money managers to discuss. So that's my consulting in my business. When people pay for my time to talk about the economy and things they don't see or they're not used to looking at. And it's very unusual. I usually get one every week or 2 that call in and want to buy 30 minutes time and talk. But this has been unusual. In 3 days, I've had 3 money managers call here completely scratching their head. And you look at the investment world out there, start with interest rates. Interest rates have been rising. The Fed wants to continue raising interest rates and probably will in December raise again. What happens when interest rates go up? Number one, the dollar does get stronger, and we'll get to that in a minute. But number 2, interest rates on housing goes up. Interest rates to buy housing goes up. People holding real estate investment trust, those stocks go down. Real estate gets stopped and it steps. Bonds go down as interest rates go up. If you're not going to hold the bond to maturity, then as the interest rates go up, the price, the principal value of the bond goes down. And because almost all companies in the stock exchange are not debt free, they have huge debt. Every time it goes up, the cost of debt goes up to them. And certainly the government is paying over $500 billion a year in interest. The interest rate goes up, then the interest on the debt goes up, and the debt compounds up faster. Then you look at stock market, and it's fully valued based on price earnings ratio. It's at all-time highs. So you say, how can it continue to go without another major adjustment? So they're asking me, what do you see? Do you see what I see? And what they see is rising interest rates, falling bonds, falling stocks. Now, most money managers wouldn't agree with this because they want you to sit still and they don't want you to be putting the money to where it should be and broken up and into a portfolio that has many different baskets in it. Then you look at the metals. They've done very poorly this year. After 2 good years in 2016 and 17, the gold market is down about 7%, silver about 10%. It's been a terrible year for gold and silver, no question about it. So what do you look at it now? You see they're calling and saying, we think the lowest risk investment in the world today is silver. Gold is 85 times price of silver when historical rates have been around 50 times. Gold being 50 times more expensive than silver. Then we saw articles last week out in the market that for the 3rd time in the last 40 years, silver has fallen below mining cost. Every time before, it adjusts right back up. So we're seeing silver at $14 spot, and it should be in the $15.25 to $15.50 range. So yes, I do think silver will adjust not only back up, but way above that price. So even though it's been a very disappointing year for silver, it's a time to keep buying when nobody else wants it, because when it moves, it's not going to move like a dime and a quarter. It's going to be like $1, $2, $3, $4 in a very short period of time. Am I predicting it's going to go up 15 times like it did from 2000 to 2011? No, I'm not predicting that at all. But I am predicting that we're going to have a big move in it, and it has been disappointing that it's taken longer than any of us would have wanted. But look at it like JP Morgan does. They buy more. They keep buying more. And the more they buy, the more assured you are that they're going to get off the short side and move to the neutral side or the long side. And when they do, they're going to make money in the futures market, and they're going to make a killing in the physical market on silver, because not only are the premiums going to go up, and the price is going to go up, you're going to see premiums going way up. So all I can tell you is, if you're an investor and you're not buying silver in your portfolio, you've got to have something wrong with you, literally. You've got to look at it and say, where's the lowest risk place I can be with the most potential? No question, it's silver. Is it gone up yet? No. Is it disappointing? Yes. Did I think it's going to move up before now? Yes. So I've been wrong. But all I do is do what J.P. Morgan and others do. I buy more. I keep cost averaging. And when this moves, it's going to be a sight to behold. So don't feel bad when one guy manages over $1 billion that call me and they don't know what to do between stocks, bonds, real estate, precious metals. They look at the debt continuing to go up, look at interest rates soaring, the interest on the debt is soaring. So it's not a very pretty picture. So what you got to do is stay diversified, keep more in cash than you normally would until one of these markets breaks. And when it breaks down, you enter that market. So if you are interested in a self-directed precious metals IRA, we can help you. We can be your broker. We can be your representative. We cannot be the custodian, but we can help you get a custodian. So give us a call at 800-247-2812. If you're not on our bullet distribution list, be sure you sign up at ftm/gold, and we don't share your email with anyone. So hopefully you can call us at the office, 800-247-2812, and we can go over in detail what we're doing. We have 2 incredible gold specials that I don't want to put out a special on because we don't have enough. We have enough for a few $100,000, not millions of dollars. So if you're interested in that, give Dan or Kathleen or I a call at 800-247-2812. So remember, gold is a bedrock of your portfolio. It cannot be created out of thin air. And every time we see the Federal Reserve create more money, gold becomes a better value and will adjust back to where it should be. It just takes one broken chain in the fiat currency market, and gold and silver both go way up. Till next week, this is Tom Cloud signing out.